So AT&T is an American multinational conglomerate holding company headquartered in Dallas, Texas. They went public in 1983, which is about 35 years ago, and they have about 270,000 employees. Now, AT&T is a very big company, so I'm going to go ahead and break down some of their operating segments next. So here are AT&T's operating revenues. It consists of communications, Warner Media, Latin America, Xandr. They also have to make operating contributions to certain of these segments to keep the business running. As you can see below, there was a significant increase in the Warner Media operating contribution, mainly because of their acquisition and move towards creating content. The reason I want to talk about AT&T is because of the news this week. Basically, one major investment firm, Elliott Management, reveals that it owns about $3.2 billion in AT&T stock, and what they did is they sent a letter to the board of directors and recommended a restructuring plan to optimize their operational efficiency, overall boost the company's value and just return more value to shareholders. It suggested that the value of AT&T could grow by 65% within the coming years if they follow their restructuring plan. AT&T's management did reply and stated that a lot of Elliott Management's plan they are already putting into effect. Looking at their geographical revenues, you can see that most of their revenue comes from the States. Also, most of their property, plant, and equipment is also located in the States. Some of the other segments include Europe, Mexico, Brazil, Asia and the Pacific Rim, all other Latin America, and other. But overall, the US accounts for more than 90% of their revenues. Now, you can see here AT&T's performance against the S&P 500 index as well as the S&P 500 Integrated Telecom Index, and it's underperformed both in the past 5 years. However, if you look at the period between 2014 to 2016, it did outperform them both, but since it's dropped severely. This could be for a lot of reasons, but last year in 2018, their acquisition of Time Warner shareholders didn't view very favorably and the stock tanked. Now, a couple areas of growth that management expects within the coming year include their growth to come from the wireless IP-based broadband services and advertising data insights, especially with Warner Media. So obviously they're deploying their 5G right now, which is going to provide a powerful platform for consumers to accelerate their move to a ubiquitous gigabit world. They've also are creating a new platform for targeted advertising leveraging existing data that their company has. They've put significant investments in their entertainment group, and they also expect to grow their Mexico business units, which was one of their smaller geographical regions currently. They hope to leverage the existing content created by Warner Media as well as develop some of their own original content coming in the future. They've recently listed J.J. Abrams on their fight against Netflix. So now let's talk about their operating environment and a couple of trends in the business. Overall, revenue growth in wireless and broadband businesses are demanding instant connectivity and higher speeds, which is going to be made possible by their 5G network. Applications like video streaming is expected to drive demand for broadband. Warner Media's premium content to drive revenue growth from its current wholesale distribution through traditional pay TV providers and new video streaming services. Across AT&T, it's expected data insights from over 170 million direct-to-consumer relationships combined with their premium video content and digital advertising inventory is expected to drive additional growth in their advertising business. From an expense standpoint, it's expected AT&T is going to continue and transition their hardware-based network to more efficient, less expensive software-based technology. Overall, this transition should help them prepare to meet increased customer demand for enhanced wireless and broadband services, including video streaming, augmented reality, and smart technologies. The software benefits of 5G and new video delivery platforms should result in a more efficient use of capital and overall lower network-related expenses in the coming years. When you talk about the market conditions of the stock market, overall, the US market was extremely volatile this year, which had early gains offset by soft near the year end. The good news is most of AT&T's products are not directly affected by the imposition of tariffs on Chinese goods. While unemployment remains historically low at 3.7%, their residential customers are still price sensitive in selecting offerings, especially in the video area. It's expected there will be ongoing pricing pressure for 2019. If you look at some of the monthly subscription costs in the US, AT&T's HBO Now is actually the most expensive. Apple TV Plus recently came into the mix this week at $5, severely undercutting their competition. Disney Plus is also new to the game and only costs $7 a month. Netflix is currently $13, and AT&T's HBO is the most expensive. Overall, pricing pressures are expected to continue in this segment moving forward into 2020. If we look further into the communications segment, you can see it's further broken down into mobility, entertainment group, and the business wireline. Both the entertainment group and the business wireline have been steadily declining since 2016, while their mobility sub-segment has been steady. Now, this Warner segment's pretty new. As you know, they recently acquired Warner Media in 2018. Shareholders hated that, and these revenues are all new, so they don't have a ton to look on here, but the biggest competition here are the rest of those streaming services we're talking about. AT&T is a telecom company. Do they really need a Hollywood studio? And that's kind of what Elliott Management has put into question here. Apple is the same way, whereas Netflix and Disney have a strong proven track record of creating original content. Well, Disney at least. Netflix is still somewhat new to the game, but obviously very popular with millennials. Now, Xandr is their advertising platform, advertising and analytics division, and they operate an online platform, which is a community for buying and selling consumer-centric digital advertising. As you can see here, it's grown tremendously from 2017, up nearly 70% from 2016 to 2017. Okay, let's talk a little bit about competition in this industry. Obviously, AT&T is a huge conglomerate, so it's hard to find a good group of comparables. As you can see, I left out people like Netflix, Apple, and Disney because their core competencies aren't the exact same as AT&T. As you can see here, AT&T has the second lowest PE ratio. Most companies fall within that 10 to 15 range, with Charter Communications kind of being the outlier. Now, AT&T does have a strong dividend yield, but they aren't the strongest in this segment. As you can see, CenturyLink has a 12% trailing annual dividend yield, which is actually crazy if you think about it, while their forward-looking dividend yield is only 7.51%. Overall, AT&T's dividend is still strong. Both their price to book and price to sales ratio is also fairly favorable, sitting right at 1.5. In the group of comparables in the price to book section, that's the second smallest price to book, and the price to sales, they have the, again, second smallest price to book. They also have the highest EBITDA at $56.26 billion. One area of concern on the ratio side is the PEG ratio. As you can see here, for AT&T, it's sitting at 3.24. It's not the highest. Verizon currently has the highest PEG ratio at 4.4. So just quickly, for those who don't know, the PEG ratio is the price divided by earnings to growth ratio. It's a little bit different from the PE ratio, as it looks to determine the stock's value while also factoring in their expected earnings growth. So it enhances the PE ratio essentially by adding that earnings growth calculation. So basically, the lower the PEG ratio, the more the stock might be undervalued, given its future earnings expectation. I want to talk quickly about the risk factors of this company. I'm going to throw up the 3 consolidated financial statements, give you my overall opinion AT&T, and then we're done. So since AT&T has such a large employee base, they have a massive benefits plan which they need to pay out. So any adverse changes in medical cost or US securities or markets interest rate could materially increase the cost of their benefit plans. Market conditions could also limit their ability and their customers' ability to access capital or increase the cost of capital needed to fund their core businesses. There's also no question that since AT&T is such a large conglomerate, any changes to federal, state, or foreign government regulations or their decisions in their regulatory proceedings or any court proceedings could increase their operating costs. AT&T, it seems, is constantly being sued by someone. It could also affect customer perceptions of their operations. Any new adoption of software-based technologies may involve quality or supply chain issues, which could also increase their capital costs. The communications and digital entertainment industry has experienced rapid changes in the past several years. An increasing number of people are using mobile devices as their primary means of viewing video. In addition, businesses and government bodies are broadly shifting to wireless-based services for homes and infrastructure to improve services to their respective customers and constituencies. We already talked a lot about the competition for wireless customers, which could adversely affect their operating results and their business as a whole. Major changes in consumer viewing patterns is also something to watch out for. Like we already talked about, many people are cutting their traditional cable in favor for streaming services or strictly just streaming for free online. There's also an increasing cost to provide video and other services, which could affect operating margins. As we've seen in the past, AT&T has made some major acquisitions. I like to compare the acquisition of Time Warner to Disney's acquisition of Marvel or Star Wars. Although Time Warner has significantly less popular content than per se Marvel or Star Wars, mature companies tend to shift towards acquisitions for growth, which is a serious risk. AT&T is also liable for cyber attacks, any of their equipment failures, natural disasters, terrorist acts. Now these are kind of a little bit broader based, but a risk nonetheless. They also have a significant debt load, which is important to note. This could hurt their future levels or future abilities to fund acquisitions, any sort of spectrum purchases, or strategic decisions which might affect their financial future. I think the biggest risk for AT&T is they're going to need to successfully integrate Time Warner into their business. Revenue synergies might take a long time to fully realize, or a lot longer than initially expected. And since they've incurred high debt in order to finance these acquisitions, it might not provide shareholders the value they expect in the near future. Now, on to the consolidated financial statements. I'm just going to quickly run through these, give you guys my final opinion, and we'll move on. Looking at their income statement, their gross revenue has stayed pretty steady the past 3 years, only varying by up to 5%. Their operating expenses are pretty much stable, around that $116,000 mark, slightly increasing from 2016 by 1.6%. And net income is kind of all over the map, so it's obviously a lot lower in 2018 because of their acquisition of Time Warner. Overall, not too much to look at here, just besides the fact that they acquired Time Warner, so their net income was significantly less in 2018. Here is their cash flow statement. Again, the only thing I really want to point out here is their acquisitions, net of cash acquired. I'll let you guys look at the numbers yourselves, but to me, there's not too much to highlight here. Overall, AT&T paid in total $85 billion for Time Warner. Here is their balance sheet for the past couple of years. You can see their cash and equivalents is significantly down from 2017. Their long-term debt has increased. They had to undertake a lot of debt in order to acquire Time Warner. You can see they almost used $40 billion in cash and then took on $40 billion in debt, which is nuts. Debt will certainly be a significant burden for them in the future. AT&T is obviously a massive business that is starting to diversify their income into many different segments. Overall, the union at AT&T didn't respond very well to Elliott Management's plan, obviously because there'd be significant cuts if they got rid of some of their non-core competency businesses. Overall, the company popped this week because Elliott Management announced that a $3.2 billion stake in this company, and they sent the letter of what they suggest the AT&T board of directors should do moving forward. I think the most important thing to note for AT&T is how are they going to integrate Time Warner? They've taken on significant debt in order to make that purchase, and now Elliott is suggesting that they get rid of it. From a shareholder perspective, I completely understand what Elliott is saying. He's telling them to trim the fat to increase the stock value for shareholder wealth. Since I'm also a shareholder of AT&T, I hope they listen to Elliott Management, although I don't expect they will. They just paid $85 billion for this content. I expect them to leverage existing content as well as spend money creating their own in the future. At the time I'm making this video, AT&T is sitting at just about $38. If they get rid of Time Warner in the future, I do consider AT&T undervalued if they plan to get rid of Time Warner. Since I don't think they will, and I believe management wants to create content, I'm gonna have to say that I truly believe this stock is currently fairly valued.